Good evening, everybody. I'm speaking specifically to Accounting 110, my Monday group that meets with me on noon on Monday. And what I'm doing here is I'm preparing another presentation because I don't think the one this morning worked out as well as I would have liked. We had good participation from the attendees, but I didn't like my side of it. So I'm going to use a slightly different set of resources here. Now, first of all, I assume, I trust, and I pray that you can see what I'm seeing here. First page of the slides. We're going to talk about cash, and the gist of this chapter, at least the meat of it's going to be how to do a bank reconciliation, how to work with petty cash, and for those of you who ever worked with a cash register, we're going to talk about that. So, this is going to be so exciting, okay? So here we go. I said, here we go. Cash, we know what cash is. It's coins and dollars. It's checks, it's money orders, it's direct deposits. It's all kinds of things. It's also credit cards. Credit cards are really cash because you hand your credit card to a company and they swipe it. That cash is going to be in their bank in a pretty quick time. Cash, okay? And it is an asset people love to steal. I bet you didn't know that, huh? So we want to have some internal controls over our assets, and we want to protect cash as best we can. And we should have things like, at the end of the day, any cash we have received, take it to the bank every day. Those of you who worked in fast food restaurants, or I guess any kind of service restaurant or a store perhaps, you're probably familiar with this. The shift ends and you bring it over to your bank and you shove it into the night deposit and you're done with it. You don't want cash lying around there for 3 or 4 days. Use checks whenever possible, huh? I guess we know that, huh? I also think we probably know how to open up a checking account, and we are not going to worry about the Patriot Act. So you go to a bank to open an account, they check your ID and they hand you the signature card. And this thing is very old fashioned, but you're still going to have to provide a specimen of your handwriting in the form at least of your signature and answer a couple of personal questions so they know it's you when you call on the phone. And the bank will hold this in their system as long as you have an account with them. When you want to put money in the bank, guess what? You put it on a deposit slip. For those of you who don't do direct deposit, like most of us probably should, huh? And the deposit ticket is going to have your account number and a 9-digit ABA number, American Bankers Association number. I bring that to your attention in case you ever need to wire money. I have some people I'm helping back east, and sometimes they got to get the money right away. And I call the bank, and as long as they have my ABA number, they'll be able to wire the money. So a deposit slip, you fill it out. I mean, we all know this, but your check, those of you who get a check from your boss at the end of the week, at the end of 2 weeks or whatever, well, you probably know better than anybody that you have to sign the back of it before you can cash it at the bank or even deposit it. Different types of endorsements. If you just sign your name on the back, that's called a blank endorsement, a blank endorsement. And what that means with a blank endorsement is you get paid at work and you get your check and you sign it at your desk. And then you go to the bank the next morning and you find you lost that check. Well, because you've only signed your name on the back of it, it makes it very, very easy for somebody to try to cash that check and likely be able to do so. Okay, you're not protected very well. But if you add certain words, I was in the habit for years and years for saying for deposit only. That means if anybody gets their hands on that check, they're not going to be able to cash it right away. Of course, they could deposit it to their account and then probably take the funds later. But the point is you get a little bit of protection for deposit only, or you can say something a little more specific. Pay to the order of Bob Smagula. In fact, I wish you would do that for me. Pay to the order of a person, yourself, or a specific bank. So blank endorsements, restrictive endorsements. Why do I go over that? Because these are the types of little multiple choice question, true, false things that are going to pop up probably on your test. Here's the restrictive one. This company here, whoever this is, Maple Consulting, they have a stamp that they toss on the bank, on the back of their check. There are checks that they receive, huh? And that's pretty typical. ATMs, oh boy, we know what ATMs are and the PIN number, huh? And guess what? It's important for the depositor to keep an accounting record of the ATM withdrawals. If you're like me, it's very easy to run up to the bank and grab 20 bucks out of it or 40 bucks. And then you wonder why you don't have any money in your checking account a week later because you forgot to record those. Writing checks. Here are 3 terms. I bring them to your attention again for testing. Testing. You bring a check to the bank, you're the drawer. You're the one who's going to draw on that money. You're going to draw that money to you. Okay? You're the attraction. I'm going to draw the money. The bank is the drawee. That's who's going to give us the money. The bank is the middleman. And the payee is, of course, the person who wrote the check. Okay? Wrote the check. You prepare a check. You're going to post it into your general ledger. And the check, they're saying here, should not be signed until the check signer has verified that all aspects of the check are correct. In other words, you work for a company and you're the one who signed, you have authority to sign checks, perhaps up to a certain limit. Before you sign the check, make sure you look at it. You know what it's all about, okay? It sounds silly, but it's very easy to get distracted and you sign something and next thing you know, you signed away money that shouldn't have been spent. And they're just showing you different parts of the check. And again, I'm going to go past this. We have bigger fish to fry, huh? The bank statement. Now we're getting to something good. The bank statement. You're going to get this in the mail every single month from your bank, or they're going to give it to you online. And what the bank statement does, it shows you every bit of activity that the bank conducted on your behalf. Some of it you don't even know about, nor could you know about it until you got the bank statement. So let's take a look at this. The statement is going to be starting off with a beginning balance. The beginning was, say, November 1st, 2020. When you get this in the mail on December 3rd, perhaps, you'll have the ending balance there. It's going to show all of your deposits line by line by line in exquisite detail. Same thing with the checks. Deposits, those are checks that we got that we're putting in the bank. They came from our customers. Checks, we write the checks, huh? Canceled checks, this is pretty old fashioned, I think. It used to be you would write your checks in hand and you would process them at the bank. You would go to the bank and cash them or deposit them. And at the end of the month, you get a thick envelope back from the bank with all the copies of the checks. I think those days are long over. I think you have to actually request that and pay for that now. You might get back a sheet of paper with a facsimile of all the checks, but more likely they're online and whatever computer system you're using, QuickBook or whatever, can link up with that information. So let's take a look at a bank statement here. Here is a bank statement. It's time to zoom, ladies and gentlemen. We're zooming the modern way here, zooming. Okay, Maple Consulting, they got a bank statement. Remember I said, you look at the numbers, it'll start with the beginning balance. That was at the beginning of this period. And then at the bottom, it says 1748.09, 1748.09. I'm gonna make that a little bigger. So there you go. And look what we see on this side here. We see the dates that the bank processed this activity. We see those dates and we see, okay, here's a check that reduced our balance, that reduced. Oh, we deposited money, and then a whole pile of checks. Ending balance is 1748.09, okay? 1748.09. Now, here we go. Let's talk about a bank reconciliation and the related journal entries, huh? At the end of the month, we saw that our bank says we have $1,748.09. That's their story and they're sticking to it, okay? What are the chances that we have the exact same balance in our general ledger as of that day? The answer is probably none, zero. There will always be differences in the month-end balances because checks are in the mail, deposits are in the mail to the bank. We've recorded them, they've not received them. The bank is recording charges we don't know about. So we must prepare what's called a bank reconciliation. And I'm going to say that this is probably the most important thing a company should do, and you and I should do it too, with our checking accounts. I have a feeling most of you say you don't do it, and I have to confess, I don't do it all the time either, but it really is necessary in the business world, huh? So let's see here. One reason you would have a difference between the balances is because of a deposit in transit. A deposit in transit. At the end of April, you were sitting in the accounting department, and at the end of the day, you saw that you got a check for $600 from a customer. You went into QuickBooks or whatever your software is, and you debited cash. You debited cash, but then you didn't bring it over to the bank for a couple days later. In the interim, the bank statement was prepared and mailed to you. So this $600 we know about, we have to tell it to the bank on paper anyway, by increasing that 748.09 number we saw. This is called a deposit in transit. And here is if a book balance would be less. Here is a check, I guess. We decreased cash. You wrote a check and it didn't get to the bank until after the bank statement came out. So those are called reconciling items. Reconciling items. Deposits in transit. Deposits or checks we received, but the bank has not recorded them yet because we put it in the mail maybe on April 30th and the bank didn't get it till May 4th. And the bank statement went out in between those two dates. So you can understand that. The deposit in transit, that's a check we received from a customer that we've recorded. It's not at the bank yet. We also write checks. The checks that we write that we've recorded in our ledger, but not yet cleared by the bank are called outstanding checks. Outstanding checks. It means that they have not been processed by the bank yet. And you're going to have a whole bunch of these typically at the end of the month. You know, you might have somebody at work who came to you for a small reimbursement on an expense report, say, and it was $22. And you eventually prepared a check for $22, and the saleswoman, she put it in her pocket or something, and she might forget about it for a couple of months, you know? That's called an outstanding check, and it's going to remain outstanding until the bank clears it. Conversely, the bank is going to tell us things we don't know. We're going to look at that bank statement, and we're going to see there are charges there, bank fees, we might see interest income, we didn't know about. We might see a payment from a customer in the form of a direct deposit to the bank. These are all things we did not know until we received the bank statement. So in preparing the bank statement, we have to figure out the deposits in transit, the outstanding checks. And when they say related errors, don't worry about bank errors. Your test is not going to have anything to do with bank errors, okay? I think there's a problem in the book where it does, and believe me, the bank doesn't make too many errors. Anytime I've had a problem with the bank, I always come in second. I never beat the bank out of anything, okay? So these are going to be our errors. We transpose the number, and then we look for the other reconciling items, huh? Identify the deposits in transit. We're going to sit down with our general ledger, and next to that will be the bank statement, and you're going to look at the first deposit on your bank statement, on your general ledger, and you're going to look at the bank statement, and if it's there, you're going to cross them both off. That's what I would suggest. You physically draw a line through the same two numbers because you don't have to worry about it. What's left unmarked is going to be your deposits in transit, okay? Deposits listed in the accounting records, you recorded it, on its way to the bank, buddy, deposit in transit, okay? And they're making a point here. If the number is different, if, for example, on June 30th, you deposited $4,121 in your records, and when you got the bank statement, the same deposit was not 4121, it was, say, 4211. Well, one of you made a mistake, and that one is you. And you'll probably have to make an adjusting entry to fix that, okay? Same thing with the outstanding checks. You're going to look at every single check you wrote, one by one by one. and you're going to cross them off, and you're going to compare it to the bank. Now, if you have, most computer systems will link up with your bank. So you probably have this online. So you're going to say, okay, this check is on the bank statement. I'm going to click it out of my module here. I'm going to click it out of the bank side and make it that much easier. Okay. Outstanding checks. And then other reconciling items. Outstanding checks and deposits in transit are both what we call reconciling items, but those are the ones that we know about. Those are the ones that we're telling the bank on paper. Now, the bank is telling us things we don't know from the bank statement. We opened up the bank statement. Wow, there was a credit memo there. Credit memo simply means the bank put money in the bank for us. Credit memo, it could have been just a payment from a customer. Maybe someone who borrowed money from us is paying us some interest. We could have interest expense. We could have interest paid. And we could have debit memos from the bank. I wouldn't worry about the words credit memo and debit memos. We learned a little bit about those in chapters 10 and 11, kind of old-fashioned words. It used to be before you return something to a customer, you had to ask them to send you a credit memo, which you then mailed in with your check. But the credit memo, debit memo, I don't think it cuts much ice these days, huh? So here we go. Here's a bank reconciliation example. And they're showing us some outstanding items, huh? There was a deposit of $637.02 recorded on November 21st, and it had not been received by the bank on their bank statement. So that is a deposit in transit. We have to add that to the bank's balance. But there are 3 checks that we wrote where we reduced our balance, but the bank doesn't have them yet. That would be subtracted, that would be subtracted from the bank balance. Now here's a check written for $18.98, but when we entered into our computer somehow, we put it in as $19.88. So the check was $18.98. Whoever cashed it got $18.98 from the bank, but we accidentally wrote it up in our ledger somehow as $19.88. So we found 90 cents more than we thought we had. The boss went to the ATM, and again, she didn't tell us she took the $100 out. Very annoying to find that out at month end, huh? So that'll be a reconciling item. Then we have an NSF check. NSF, non-sufficient funds. For those of you not familiar with that term, it means the check bounced. For those of you who don't know what I mean by the check bounced, it means that this person wrote a check and they don't have any money in their bank account. We accepted it in good faith, deposited it, and learned only weeks later that the check was no good, and the bank charged us a fee. So let's just take a look here. Let's take a look at this bank reconciliation, and then I'm going to go into another textbook I like and show you another one. We can do it together, and I think this will help out a bit. Okay, here we go. Bank reconciliation. It's an odd day to do a bank reconciliation, November 21st. Typically, it's the last day of the month. So what happened here? Here's our famous 1748.09. That's our starting point. They told us over here that we had a check for $637.02, right? That was on its way to the bank. So that's a deposit in transit. That will be added to the bank balance. And then we had 3 outstanding checks. So your beginning bank balance plus deposits in transit plus minus outstanding checks equals the adjusted balance. Balance per the bank statement plus deposits in transit minus outstanding checks equal your adjusted bank balance, we're going to call it. That's all you have to do on the bank side. That's all. There are no journal entries to prepare for the items that are on the bank side. And why is that? Because everything here, deposits in transit, outstanding checks, these are things we've already recorded. There's no entries to be made. We're just putting our worksheet together with it. So now we have to go to the items that the bank told us, okay? Here, we're telling the bank, So now we go to our beginning book balance, which apparently is 239323. And we had that error on that check that came out 90 cents light or too much. We find out we have 90 cents more than we began with. We deduct, there was an ATM fee. Remember we said the boss went to the bank and she didn't tell us? Now we learned that. We have a bounce check for $200 and we have a bank service charge of $1.80. So the beginning book balance plus and minus these various reconciling items, they can be different each month. You might not have any sometimes, maybe just one or two. Beginning balance plus and minus these reconciling, look what you come up with, 209233. We have now prepared the bank reconciliation. We have reconciled the bank statement. If the bank knew everything we did, it would have a balance of 209233. If we knew everything the bank did, it would come out the same. What if at the end of this process, you know to an absolute certainty that you recorded everything correctly, that you entered everything correctly from your records, and then you find out the bank's balance is, say, $2,092,000, and at the end of the month, your bank balance is $100. You got a mighty big problem there, huh? You might say, well, let's talk to Maria. She's the one who handles all these banking transactions. And someone said, oh, Maria called in the other day. She quit and she moved to Afghanistan. You've been robbed is what I'm trying to say in a rather silly way. That's why these reconciliations are so important. Suppose the bank did make an error. We may never know about it. We may never know about it. And we certainly do want to know about it, okay? Bank reconciliation. No journal entries up here. No journal entries for anything on the bank section. Here, these are all journal entries, huh? We're going to have to figure out what to do with that 90 cents and this withdrawal and the bounce check and the fee. So let's take a look here. Well, the 90 cents, they're just going to, what happened was when they paid that money out, they credited cash, it looks like, and debited accounts receivable. We realized we credited too much to accounts receivable, so we debit that. So we're gonna credit that back and give us back the 90 cents. Okay. The drawing, the owner took money out. We found out it was a drawing, and now we record it. Look at the bounce check. You notice we debited accounts receivable. Well, the reason for that is when we received this money from our customer, we debited cash and we credited accounts receivable, thinking that we had money. Now we find out that that customer sent us a bad check. So we have to credit the cash. We don't have that cash anymore, and debit them back on the accounts receivable and give them a tongue lashing first thing in the morning. Hey, you gave us a check that bounced. What's going on, please? Find out what's going on. And then they put this $1.80 into miscellaneous expense. This could have been called bank service fees or something, okay? Electronic banking, I'm not too interested in that, okay? Now, what I would like to do is take you through one more bank reconciliation presentation. So let me see if I can find this. Give me one moment here. Share. Okay, this is from a different textbook, okay? So let's look at another bank reconciliation. Here we can kind of do it together. And I think if you look at this a couple times and you'll be able to get the hang of these bank recs, huh? Again, they're telling us that cashes, money orders, bank drafts, treasury bills under 3 months, I guess, certificates of deposit. Internal control of cash, segregate those duties. Don't have the same person do the same thing all the time. And someday I'll tell you all the story about the girl from Santa Barbara who's in jail now for embezzling tons of money from the police department because she was put in charge of the traffic fines. She was given the ability to do all of these duties, the recording, the custody, the authorization. Add to that the computer boss. And this poor woman fell victim to temptation like many people would. She learned very quickly that when she received a parking ticket from you for one of those pesky parking tickets around town, she would go into the computer system and delete it. So it never happened. And then she would take that check that was made out to the Santa Barbara Police, and she would deposit in her account called the Santa Barbara Police Compensation Fund or something. Anyway, you segregate duties. Bank reconciliation, huh? Take a look at this template here. This is in your book in a similar manner. The bank side, bank balance plus deposits in transit minus outstanding checks equals the correct, or what we're going to call the adjusted bank balance. All reconciling items on the book side require a journal entry. No journal entry on this side. Here, balance per the book plus any deposits or any pluses, minuses get you there, okay? So let's spend just a few minutes on this. And here, they're giving us some information. This company, the bank statement has a balance of 9610, and our books are 7430. And then they're giving you some information here, and we'll get back to this in a moment. So let's take that 7430. Wow, they really got ahead of us, huh? Holy cow, they did the whole thing. I thought they were going to let us do this piece by piece, but, but let's take a look at it. It kind of takes the wind out of my sails. Here's our beginning balance. You pop that in. You would start by putting it right up here and here. And there it is, the 9610 and the 7430. Let's see what else they tell us. Well, they had outstanding checks totaling $24.17, and a $500 check mailed to the bank for deposit had not reached the bank. So that's a deposit in transit. That's a check from our customer. We recorded it. It's on the way to the bank. These are checks we wrote that the bank has never seen before. So armed with that, we can pretty much finish the bank side. So look what we have here. We have deposit in transit 500, outstanding checks 24.17. Now remember I told you don't worry about bank errors on the test. This goofy problem gives us one where the bank made a mistake. A deposit by the Acme company was credited to our account by mistake. Believe me, that's not going to happen. It's not going to happen. But in this question, it did. So that's money that does not belong to us. And we have to tell the bank now. We actually have to call the bank on that one. And they say, look, you guys fouled up, huh? That's your money. That's somebody else's money. So we come up with the correct cash balance, adjusted cash balance of that. And then let's see what we have here. Well, we have a bounce check, NSF, non-sufficient funds. Probably have to put that back into accounts receivable. We have to record a $30 interest income. Hey, that's great. Now, here's the type of mistake you will see, our mistakes. Here we have another check screw up. We wrote a check that cleared the bank for $268. The bank took $268 out of our bank account. We thought the check was only $240. So that's $28 we're going to lose. So take a look, $74.30 plus that $30 interest minus the NSF check. And the 28 is the difference between the 268 and the 240. We're now reconciled. No journal entries needed on the bank side. Journal entries needed on this side, okay? Bank reconciliation, here's your journal entries. We debit cash, credit revenue for that interest income. And what they're doing here, they're combining the last three or so. They're combining these three guys together, which I don't really like, but that's okay. We can work with that. The $28, they're debiting inventory because that's what we bought when we originally recorded the transaction. We just didn't record enough inventory. We put the bounce check back into AR, and our credit is to cash. So armed with that, that's a look at the bank reconciliation. Now, I'm going to finish up very shortly here by going to the rest of our chapter in our book. What you saw was from a different course. So let me see if I can pull this thing back up here. Okay. Now here's our book here. Let me see if let me make sure I share it. Let me share and share like share. Okay, here we go. Okay, we finished up with the bank reconciliation here. Then I went to the other book to get a little clearer look at it. Electronic banking, electronic funds transfer. That's what your direct deposits are all about, right? Petty cash fund, petty cash. A lot of little tiny expenses come up during a working day. Somebody, the boss sends somebody out, take your car, John, and drive over to Goleta and pick up my lunch. The boss says, okay. That's a bad example. Go to Goleta and pick up something we need for the factory. So you drive up in your own car, you bring it back, and your company reimburses you for mileage. So you get $1 a mile. So you made about a 20-mile round trip. That's $20. The company probably doesn't want to go to the trouble of setting you up in the system as a vendor and then having you wait for a check until the day they run checks. They're going to pay you out of something called petty cash for small items that occur all the time. And this is typically what it sounds like. It's a petty cash. It's a box, like a little tiny metal box with coin slots and room for 1s and 5s and 10s. And it's run by one person, the custodian. And just like the bank, it gets reconciled at month end. And this is a time saver. You know, you have a guy from UPS comes in and he's got a COD for $8. What do you do? Tell him come back in 3 days because that's when we run checks? No, you're going to hand him $8. He'll sign the receipt and off you go. Petty cash. So let's understand the journal entry. To set up the petty cash fund, we debit a new cash account you're seeing for the first time called petty cash. Not too hard. You debit petty cash and you credit cash. When you look at your balance sheet after this, the first item you're going to see is cash, and the second item is going to be petty cash right below it. Okay? So that's your journal entry. And once you establish this petty cash threshold, which is now 100, as long as that stays at $100, you'll never touch petty cash again in terms of a journal entry, okay? So the petty cash custodian typically has a receipt exactly like this. I don't think this has changed in the history of the world. It's just a piece of paper, and he or she quickly writes out, well, I'm paying James Maple. He took a customer out to lunch, and here's the amount, and everybody signs it. And that goes into your petty cash box until the end of the month. And you're going to keep track of the petty cash payments in a multi-column record that supplements the general ledgers, Provide a record of each payment, and it'll be broken down into the categories you use most frequently, okay? When do you replenish petty cash? Hopefully just once a month. If you're replenishing petty cash every week, that's a problem. That's a real problem. It means that you are paying too many big items at a petty cash that should perhaps be paid from the accounts payable checkbook, or you don't have enough funding in petty cash. Petty cash should last you on average about a month. And I always liked that one question on the CPA review. I still remember it, like 40 years ago. They gave you four possibilities, and you were to pick the one that indicated a problem. And the first one says, well, you're having somebody sign for the goods, or you're paying small. The first three were clearly good controls. And then the fourth one was, you're turning the petty cash over 3 times a month. No good. No good. Because the petty cash payment record is not a journal, no journal entries. And we're going to look at the petty cash fund in just a moment, okay? Here we go. Petty cash. At the end of the month, the custodian opened up her petty cash box and she saw there was $11.20 in there, okay? Wow, we started off with 200. She only got 1120. So now she counts the receipts, and the receipts add up to $188.80. 188.80 plus 1120 is $200. Right on the nose. Perfectly done. So this person is going to record the results of the petty cash, or someone in accounting will, into the general ledger, and then they're going to write a check for $188.80, give it to the custodian of the petty cash, and he or she will cash that and replenish the fund. And this is an example of the type of entry. We said that they had $188.80, huh, in vouchers. Well, 40 was for automobile expense, postage, travel and entertainment, miscellaneous, and the boss took $30 out to bet on a horse or something. Okay, so that check for $188.80 is going to go right back into your petty cash box. The credit is not the petty cash. We've already got the 200 there on the records. We credit cash. And then we're going to talk about a change fund. I bet some of you have worked in restaurants, huh? Run cash registers, and you're not always exactly right. You have days where you're over and short, I would imagine, unless you're super perfect. It's human nature that a mistake can be made, and hopefully not a big mistake, but little ones. Those are kind of expected. That's noise in the system. Doesn't mean that anything is terribly wrong, but you handle money for a busy 8-hour shift, you're likely to have a little flub here and there. So let's talk about this. Change fund, it's a supply of money that's kept in the cash register. It's similar to petty cash. You're going to debit an account called change fund. And again, you're not going to touch that change fund unless you decide you need more to start your business day. So at the end of the day, you're going to leave, say, $200 in the cash register. And then at the end of the day, you receive cash, and we're going to count the cash and record our revenue, huh? So look at this. It came out perfectly. It came out perfect. Oh, I'm sorry. That's to, I was way ahead of myself. That's to record the fund. We debit the change fund. We credit cash. Okay. So now we have 3 cash accounts. We have cash, petty cash, change fund. Here we go. At the end of the day, there was $450 in cash in the cash register. We're not talking about credit cards now, just cash. Well, we had $1,450 at the end of the day, but we know we started off with 200, right? So that $1,250 is the amount of cash that increased. That is our debit to cash, $1,250. We're going to debit cash $1,250, and we're going to credit sales, or we're going to credit meals, or whatever the restaurant. I'm always thinking in terms of a restaurant. You know, this will be, dinner revenue or something. Okay, came out perfect. It came out perfect. But guess what? Like we just said, you're going to make mistakes. You might be short or over. So coming to the rescue to help you is an account called cash short or over. Cash short and over. If you ask me if this is an expense account or a revenue account, I'll say you can call it whatever you want. Let's call it a revenue account. We're glass half filled people. In other words, if we make an error that is favorable to us, we're going to end up coming up with more cash and crediting a little extra income. The other way, we're going to end up losing some cash. Take a look here. Nice, simple example. Nice, simple example. 1161 in the cash register, minus 200. We had sales of 961. That 961 represents your revenue. We have to credit revenue for the 961 because that's what your cash register said you sold in meals, 961. The increase in the cash, though, was 963. It was 961. We sold, according to our records, 963, but we only have 961. So that would be a loss. So let's just take a look at our journal entry here if I get this thing to snap out of its funk. Oh, now I'm getting mad. All right, we do it the cash shortage. Here it is. We'll do it the hard way. There we go. There's your journal entry. We debit cash for the 961. We know that's how much cash we increased. We know we had 963 in sales, and we know our revenue was higher than the cash, so that's a loss of $2. Same thing if it was a gain. Here, we had 1015 at the end of the day in cash, minus the 200 we always leave there. 815, we only sold 814, so somebody walked out of here $1 short. And that is to our benefit, if you want to say that, okay? Cash overage. And now I'm going to finish in about 5 minutes or less, just to show you one other item. Share. Oops. Here is your petty cash reconciliation report. The chapter didn't do this. This is actually from my last 110 class when I was in the classroom. This is part of my test. And what we have here is a $100 petty cash fund. So on the first, you just put the $100 in there, huh? And then look at the transactions. I'm not going to do them all, just do a couple. But here, we bought some blue markers for $825 on the third. Well, $825, that looks to me like that is stationary. So we come up with our new balance. It would be 100 minus 825. And I guess that would be 91.75, if I did that right in my head. 91.75. Next transaction was the UPS guy. $5. This will become 86.75. 86.75. And I'll do one more, postage. We had postage for 1533 on this date. 1533. So this would become 7142.42. Okay. So you get the idea. We keep putting these things in here. And then at the end of the month, we're going to add all of these up. Now we're going to add everything up. Don't need that. Well, I made one little mistake, huh? We don't want to add this column up. We want to take this number. This number here is going to obviously be the 7142. That's our ending balance, okay? Our ending balance is 71.42. You don't add these numbers down, okay? So we spent 70, we have 7142 left. Here, $15 in postage. You would debit postage for 15. Postage. You would debit stationery. Stationery. You would debit deliveries. Delivery for those amounts. So that would be 15.33, 8.25, and 5, and 5. And we're going to credit. What do you think we're going to credit? Cash is what we're going to credit, huh? Cash. Cash. Because now we're putting that money back into the petty cash fund. And this added up to 2858, right? We'll see if I did that right. 2858. So I hope you get a little sense of this. Here is the journal entry to set up the petty cash. You debit petty cash and you credit cash. And we said it was a $100 petty cash box. Okay. So let's look at the petty cash reconciliation report, and that'll be part of your homework, okay? And then I did one of my silly little examples here, calling on my New Jersey roots back in central New Jersey. There's a very nice restaurant in my hometown. It's called Vinny Abruzzi's, a little touch in Newark. The change drawer starts each day with 200. On a recent busy Friday, this cash-only restaurant recorded meals for 6308. So 6308, we know immediately is going to be our sales. I don't know if they call it meals revenue. Okay. When cash was counted at the end, we only had 6,000. When cash was counted, it came to 6,000 minus the 200. So our cash really went up 5,800. And the difference is, to me, $508. So we're way off here. We're way off. Cash. Then you got the over short. Okay. The cash register was short, and Vinny was pretty miffed. And you want to miff Vinny, believe me. So that's a simple look at recording the cash over short. I have a feeling, I would guess that probably half this class has worked the cash register at one time. I actually never did. I worked for a department store for years in high school and a couple of years of college, but I never hit the cash register. So I think that brings us to an end here. I hope this is helpful to you. And I'm also going to put up, maybe even tonight, a lecture I did on chapters 8 and 9, since that will end the course, actually. And maybe that'll give some of you a head start. And I do encourage you all, join me on Monday when I'm fresh like this, when my brain is working good. You get to me late on Friday, it might be a different story, right? So anyway, you take care, everybody, and happy studying.